Hello students, in this video we will understand how do we classify the capital asset as short term or long term, which depends on the period of holding. First of all, sir, why do we want to classify the capital asset as short term or long term? Guys, because short term capital is transferred, it will lead to short term capital gains. Same way, if there is a transfer of long term capital asset, it will lead to long term capital gains, and the tax rates under the income tax law both on short term and long terms are different. So it is very important for us to first classify whether the capital asset is a short term or long term whenever it is transferred under the head capital gains. So if the capital asset is held for more than 12 months, 24 months or 36 months depending upon the category of the assessee, we term it as long term capital gains. Whereas if it is held for less than or equal to 12 months or 24 months or 36 months, then we call that asset as short term capital asset and we calculate short term capital gain on the transfer of the same. And with respect to this, we have a tax rates which I will discuss in the next video. Coming to the period of holding, sir, you told if it is held for more than 12 months or 24 months or 36 months, it is long term, if not short term. Now, how do we know, sir, for which asset, what is the period of holding applicable? Guys, first of all, what is period of holding? It is a time gap between the date of purchase and the date of transfer. Just so. So, if the transfer has taken place before 23rd July, which is a key date for the capital gains aid, guys, because there are few amendments which has happened on this date. So, most of the provisions will be applicable as it is from 1st April to 22nd July, whereas from 23rd July to 31st March, there is a slight change. Okay. So, if the transfer has taken place before 23rd July, then there are three category of assets, guys. So, first category, first list, it is the listed securities, both equity, preference as well as debt on a recognized stock exchange, unit of equity oriented fund or unit of unit trust of India and zero coupon bond. If these three assets are held for more than 12 months long term, less than or equal to 12 months short term. Okay, so then coming to 24 months category, there are two assets here, unlisted shares only. It doesn't include the debt instruments, unlisted shares, both equity and preference, and land or building or both, which we also call it as immobile property. If these assets are held for more than 24 months long term, less than 24 months means short term, guys. Then any other assets will fall under 36 months criteria. I have also named a few of them because students might have confusion here. Unlisted securities other than shares like debt instruments, unit of debt oriented fund, unit of business trust and other capital assets. Why I have given specifically other units of business trust, guys? Because this is a part of section 112A and 111A. 112A and 111A, it is a part of it. So that is why you should be knowing where it falls. When do we consider it as long term or when do we consider it as short term? You should be aware of. So that is why I have given. Whereas the unit of equity oriented fund and listed shares, that is equity shares, will fall under 12 months criteria. Whereas the units of business trust will come under 36 months. Yes, sir. Sir, what if the transfer is after 23rd July? That is on or after 23rd July. Then there is only two criteria here, guys. 12 months and 24 months. No 36 months. What is that, sir? So 12 months, same three assets. No change in it. Whereas the rest, all the assets fall under 24 months, guys. Very easy to remember. So madam actually made it easier. So 36 months has been removed. So in simple, guys, if I have to go back, so here whatever is there, okay, this remains same. Whereas this two combined together, they have made it as 24 months now, both put together. So if the transfer has happened before 23rd July, there are three criteria. Whereas if the transfer has happened on or after 23rd July, then only two criteria, guys. Yes, sir. But there are few cases where you will always compute short-term capital gain irrespective of the period of holding, you always compute short-term capital gain, guys. That is, as per section 50AA, there are three category of assets covered here. When it is transferred, it is always short-term. We need not even check the period of holding. So, which are those three assets, sir? Units of specified mutual fund acquired on or after 1st April 2023, market linked debentures, and this is an amendment, unlisted bond and unlisted debenture which is transferred, not purchased, transferred or redeemed or matures on or after 23rd July. On or after 23rd July. So for this three asset, it is always short term plus even section 50. That is when section 32 fails, depreciation fails. Immediately section 50 will take over to compute short term capital gain or short term capital loss, guys. So these are two special cases where we always calculate short term, and those short terms are always normal income taxable at the rates applicable to the assessee. They are not special incomes. They are not covered under section 111A, guys. So I have also given the format to compute short-term capital gain and long-term capital gain. Only difference is, guys, for long-term capital gain, there is an indexation available, whereas for short-term capital gains, you cannot claim indexation for both cost of acquisition as well as cost of improvement. And I will discuss about the indexation in the next video, guys.